So I was reading a CNBC article, and it was about Wood Mackenzie, and who's some energy researcher slash consultant. Um, and so what I saw in the article is uh, Wood Mackenzie said that oil prices could hit $10 a barrel in 2025 if the Paris Climate Accords, the goals are reached. And I thought that was the funniest thing I've ever read. Well, maybe not ever read, because I've read some funny things, but it's one of the most. I mean, I don't know how to describe it. It's the most like clueless comments I've ever read. It's got to be up there. Oil prices hitting $10 a barrel. I mean, okay, look. First of all, I don't think that's how it works, because look, if the demand for oil drops, by 90%, let's say, or whatever percent, that doesn't mean that oil prices drop by 90 or 70 or 80%. Oil demand could drop by like 90, 80%, and the price would stay, well, the price would drop, but it wouldn't drop past a certain threshold. And the reason for that is because there's a cost of producing oil. There's first of all, there's setting up all the drills and setting up all the prior stuff, and the exploration, which all this costs a lot of money. There's the financing, and then you got to pay back the interest on the debt, and there's all that, which costs a lot of money. But there's also the cash costs of drilling the oil and mining the oil, and actually being able to get the oil out of the ground. There's a per barrel cost to that too. And I could tell you, I mean, I don't know the exact number, but it's a lot higher than $10 a barrel. So there's no way that oil could stay at $10 a barrel for any reasonable amount of time. Now, the price of oil did go negative, back in 2020, and during the recession. But I mean, that was because of the whole futures market trading thing, and that's because people didn't have anywhere to store the oil. So they were buying all these oil future contracts, and so when people came and were delivering the oil, the people who bought the paper oil didn't want the physical oil, and so they didn't have anywhere to store it, and so they had to get rid of it. And so apparently it traded at negative prices. Now, I don't think anybody really was able to buy oil at negative $37 a barrel, or at least buy any substantial amount of it, because it's just such a, it's the time period that it lasted at negative prices was so small that no big let's say holders of cash was able to buy it. They just didn't have the time to. And so there's no way the prices of oil could last that long, that low for that long. And I think what's even more important is that no companies would produce oil for $10 a barrel. Right? No company will keep on selling oil for $10 a barrel. Now, if the demand for oil dropped 90% by 2025, or whatever percent by 2025, what would happen is a lot of oil companies would go out of business. A lot of oil companies would shut down, and the volume of oil, the trading volume would shrink substantially. But the price of oil could, I could see it staying the same. At $60, I think it's a pretty reasonable price target for oil. Now, that all depends on how low the currency unit goes, because by 2025, if you think $10 today is still going to be worth $10, then you're way too optimistic on the whole US dollar. And you know what happens? Maybe by 2025, oil isn't even trading in US dollars. Maybe some other type of currency is going to replace the dollar. Is it the petrodollar? Is it going to be the petro yuan? Is it going to be the euro petro, the petro euro? Is it going to be, what is it going to be? Or is it just going to be, many oil markets trading in many currencies? Who knows? 2025, it's hard to say. But what you could know is that it's not going to $10 because companies just won't produce and sell oil for that low. And when oil was trading at negative, people who were selling oil were for negative prices. They were the oil traders. They weren't the big oil companies. They weren't the producers of oil. The oil producers weren't selling their reserves of oil for negative money. What they do is they just hold it, and they just keep it and save it. They don't sell it for prices that they can't even make a profit off of, unless if they need it to kind of finance their debt or something like that. But it's very rare that it's very rare that they'll sell it for incredibly low prices, and it's impossible that they'll pay you to buy their oil, because if they need money to finance their debt, their short-term debt or their interest payments, and then they need to sell their oil reserves for a small sum of money, they're not going to pay you to do that. That's just completely counterproductive in every way possible. So there's no way that oil is hitting $10 a barrel by 2025, whether or not the Paris Climate Accord, whether or not that works out. And again, look at who the big users of oil are. Countries like China, India, Russia, and of course the United States. But even if the US did go through the Paris Climate Accord, China, India, Russia, do you think these guys are going to be completely on board? And so just $10 a barrel of oil is just completely silly. And if you look at the producers of oil, if oil goes to $10, the producers are all going to use oil, right? Nobody's gonna just sit on their big oil reserves and not take advantage of it. Saudi Arabia, Russia, and China. If nobody wants oil, and there's no cheaper, better way to get energy, well, these guys are going to use oil. But the whole economics of it is just completely, it's just completely flawed, because demand for, there's a threshold for how low oil can go for a reasonable period of time, because then nobody produces it. And so this thing was just, I don't know how to comment on it other than I thought it was really funny, but it's also really flawed. And talking about oil prices and energy prices and all of this, I want to go back to early April, where the US producer price index increased by 1% in March. And for this, I'm saying this because I thought of just another way of looking at it. Just randomly thought of this, and I thought it might be very valuable, and it might be what actually ends up happening with inflation and all of this. And I think it's very, very underlooked by pretty much everybody who thinks of inflation and who believes inflation is coming. This aspect is, I think it's a very underlooked aspect, I guess. And I think it deserves a lot more attention. And so the PPI, the producer price index, in March increased 1%. Now the PPI is basically, it's kind of like the wholesale cost for producers. So like, like stuff like raw materials. And so instead of the CPI, which is the consumer price index, it's kind of like the CPI, but for producers. And a 1% in March. So that's the greatest increase in 9.5 years. And 1% in 1 month, that's a big increase. A lot of it, I think, is due to the increase in prices of natural resources and commodities. So if you look at the price of agriculture and energy, you'll see, everything there is just rising very, very quickly. And if you look at some of the industrial metals like copper, well, a while ago, it was, it had its big rise. And so I think you'll see a lot of, producer price inflation happening there. And why that is important, and I think it's incredibly important, is usually when people think there's inflation, they think it's going to come from, the fiscal spending and the rough monetary policies, and keeping interest rates so low, and the government sending all these checks and spending all this money and flowing into the real economy. And so there's more bank deposits, everybody has more money in their bank accounts, and so I think a lot of people think that this is going to be the thing that causes the inflation. And I think it is, but there is a difference between that and what I'm saying here, which I'll get into right away. And so, the common view of inflation is this. It's this top-down view. So, government and monetary policy. And so everybody has more money and everybody's going to spend more money, and that's going to, make the prices go higher. But I think, I think that's a possible way that inflation could happen. But I think if you look at it from a bottom-up perspective, it's very, very interesting. And I think that could be how inflation starts, right? If you don't know when it's going to start, because finding the when is very, very difficult. But when and how it starts could maybe be found by looking at stuff bottom up. And you see a lot of evidence of, bottom up inflation instead of kind of the top down, where, it's fiscal spending, monetary policy. And I'll get to what bottom up is right away. So, well, first of all, let me go back to top down actually. And so, the government gave out around $6 trillion of fiscal stimulus, fiscal support ever since COVID-19. And, it was mostly funded by debt and debt monetization from the Fed. And, government was running all these large fiscal deficits, raising their trade deficits. And so that is an inflationary type of policy. Now, I guess trade deficit isn't really a policy, but that is eventually, well, I guess it's eventually deflationary, unless if you use debt and debt monetization to get out of your trade, your eventual, let's say, need to go back into a trade surplus. But so the government gave out stimulus checks, and so that's like directly inflationary. And well, unless if people decide to save them or to pay back debt, but it's inflationary anyways, because not everybody's going to save them and pay back debt. So it's just a matter of how inflationary it actually is. But it is inflationary. And so, there's more fiscal spending, and who knows, maybe there's more checks to come back in. There's talks about, another COVID stimulus, and maybe we're going to get more checks. Maybe we're going to get more free money. And so that could be a possible event that happens. And if it does happen, then, we could see worse inflation. And so, a lot of people think these are going to cause inflation, but it could start off differently. And that's because too many people focus on the CPI and not the PPI. So what happens is, my prediction is that maybe inflation is going to happen. It's going to start off from the PPI, the producer price index, rather than from the CPI, the consumer price index. And so what I mean is, once the big commodity companies, once their reserves are depleted, you'll see an even bigger increase in the PPI than you did in March. And so, what I mean is that, big reserves, big commodity reserves are gathered and they're saved up during these periods of cheap commodity prices. And, I was talking about that right before with the price of oil. People don't sell oil when it's trading at $10 or, negative prices. At least the big companies don't usually, unless if they, again, got to, finance their interest or something like that, which is quite rare anyways. But they don't usually sell their commodities when it's cheap. But once it becomes expensive, they'll start selling, or at least once it reaches a certain, price that's high enough to actually have reasonable profit margins, they'll start selling their commodities. And, right now, the big companies are selling. And what you see with that is that once the commodity reserves are depleted, you'll see that the prices on these commodities are going to go much, much higher because they don't produce these, commodities that quickly. And, it obviously takes some time to produce them. And so you're going to have the same demand, you're going to have a lot less supply, and all of the commodities are going to cost a lot more. And when you want all of this economic growth, if we get an infrastructure plan and, new innovation, new building, new manufacturing, whatever you want, you need these raw materials. You need the commodities, you need natural resources, you need energy, and you need industrial metals. But when these reserves become depleted, your raw material cost increases substantially. And, what happens when the PPI increases? The prices for the producers increase, their costs increase. Okay, well, these guys need to raise their prices as well. And that moves on to the CPI. It doesn't start from the CPI, but the producer prices move on to the CPI. The increased costs of these raw materials are transferred to the consumers. And a good example of this is if you look at the price of lumber. In pretty much a year, it's had around 85% growth, which is a lot of growth for the price of lumber. And if you also compare the growth, price, cost, the growth and costs of stumpage, it hasn't grown much at all. Now, if you're wondering what stumpage is, it is the price that a private company or firm or whatever pays for the right to harvest timber from a given land. So, it's paid to whoever owns the land. And you could see it as kind of like renting a place, except you get to harvest the stuff that is in the place. And in this case, it's trees. Stumpage is you're harvesting the trees in a field, or whatever land. And if you look at the price of stumpage, or the cost of stumpage, first of all, it's usually based off of, like, per tree, you have to pay this much or whatever. That's how it's usually measured. But if you look at the stump prices, it's at 10-year lows. And that's the price of what it costs to get a tree. And basically, that's where the main costs of getting lumber, at least the base costs of lumber, comes from. And in some places it's at 10-year lows. But if you look at the price of lumber, I mean, it's crazy high right now. And so you have this huge spread between the prices of lumber and the prices of stumpage, or the feed price of stumpage. And I mean, that's just caused by low reserves and high demands of lumber. And that's what you'll have with all of the other commodities as well, if you don't increase the reserves, because the demand for these commodities they're not low. Now, they're not stupidly high, but they're not low. And I mean, the reserves, these guys just came out of it's kind of a cycle where commodities didn't, for around 7 years or so, commodities didn't really do that well. They just kind of sat there. They dropped from their all-time high. They just kind of sat there, and not at a price where companies can make a big profit anyways. So these guys were saving up reserves. But when the reserves are depleted, like they are with lumber, I mean, the cost of producing these commodities, or mining, or drilling, or whatever, they stay pretty much the same. But there are so few reserves, and that the cost of buying the actual commodity itself becomes so high that now the producers need to increase their costs, and by increasing their costs, they need to pass it down to their consumers. And for lumber, I think a lot of it is due to the high demand to build homes. Now, the high demand to build homes causes home prices to go higher, and the high price of lumber also causes home prices to go higher. And then home prices go higher, and then people want to buy homes, and then that causes the price of lumber to go even higher, and then the price of homes go even higher. And so you have this very dangerous inflationary kind of self-perpetuating cycle that happens in rising house prices and lumber. And what you get with this is, while people are happy that the prices of their homes are going up, at least people who own homes are renters, and people who don't own homes, those guys are not happy at all. But people forget that your house is not only an asset, but it's also something that it's also something like a good. And I mean, look, people are mad when the price of food, or the price of gasoline, or the price of whatever, computers, go up. But they're mad. But when the price of homes or their stocks go up, I mean, they're happy. That's like the best thing that happens to their financial well-being. The price of my home went up 15% this year, and they're all happy about that. But they don't look at it in a way where maybe the price of clothing went up 15% this year. That'd be terrible for everybody. Everybody would hate that. And when there's a discount on clothing, 15% off, people aren't like, oh no, the price of clothes went down 15%. That's terrible news. But people are like, that's great. But if the price of clothing went up 15% on a given day, well, if the little tag wasn't 15% off, it was 15% on or 15% extra. I mean, nobody would want that. But for housing, I guess, and stocks, I guess it's different because everybody wants more expensive, higher priced assets. But it's not the same for consumable goods or services. Everybody wants cheap, stuff, and everybody wants expensive assets. And well, that's causing this self-perpetuating housing price increase to keep on rising, and the price of lumber, because of it, keeps on rising as well. And well, it's obviously not going to last forever, especially where I am in Canada. The housing prices here are kind of ridiculous. But it could go on for another year, another 2 years. I don't know how long it could go to, but if this type of inflation, housing inflation, moves on to other commodities, if lumber, if it's not lumber, but it's some other commodity that the big companies who produce that commodity, if their reserves are depleted as well, well, look what ends up happening. What ends up happening is that the housing inflation could happen to other companies. What if Walmart was housing? Well, they're going to everyday low prices. Well, they're going to raise their prices every day. And what's scary is that housing inflation could become CPI inflation. It could, CPI inflation could just be a repeat of housing inflation, because housing inflation is kind of self-perpetuating, but CPI inflation is self-perpetuating as well. People see, rising prices, and they're all afraid that inflation's coming. Right now, the inflation fears are at pretty high levels. So if the PPI increases, and all these companies are forced to increase their prices for their goods because of the increase in raw material prices, and then the prices of goods and services could increase without governments having to do anything. And that all starts from the commodity extracting mining companies running low on reserves. And that happens because they're selling their reserves for I guess you could call it a underpriced price, which is kind of where we're at right now. If that happens, you'll get a lot of PPI inflation, which could eventually translate into CPI inflation. And you're seeing that already with Coca-Cola. The Coca-Cola CEO not too long ago said that the Coca-Cola will raise their prices to offset higher commodity costs. So you're seeing that already with Coca-Cola. And I think a lot of other companies are to follow. I mean, look, Coca-Cola, why do they need a lot of commodities? I guess their cans are made out of aluminum, but I mean, if you look at a company that uses a lot more metal, that's not Coca-Cola. Let's say it's like a car manufacturing company, or it's I don't know, just another company that uses a ton of metals. because they have to, their prices are going to raise a lot more than Coca-Cola's will. And Coca-Cola is already doing it. So, this is a really different way of looking at where inflation starts. And again, increasing the money supply will definitely cause and worsen inflation, but that might not be how inflation is really started. So I think this whole episode was very, very important, and I think it really gave a good insight in how I think inflation could be started. Now, of course, all of this monetary fiscal policies, all of them are going to worsen the inflation problem, but I think that might not be where inflation really starts. So, that's it for this episode. And, you should come back for the next episode as well.